Good afternoon, everybody. This is Mark Salter. I'm the Executive Director for CFA Society Minnesota. Thank you all for tearing yourselves away from the latest election results to talk about a different kind of performance. We are thrilled today to have a couple of wonderful experts in the topic of global investment performance standards. And it's my pleasure to introduce Ivana Bertuzzelli, who holds the CIPM designation. She is coming to us live all the way from West Palm Beach, Florida. So enjoy her background. Those of you in Minnesota, it's a beautiful day here today, but it won't be for that much longer. So thank you, Ivana, for joining us. And speaking with her is Ken Robinson. And those of you who have been working in the field for a while will recognize Ken's name. He is a member of CFA Institute and the guru when it comes to CIPM and GIPS and all of those wonderful things. So Ken, thank you very much for you and Ivana joining us today. I am going to very quickly do two thank yous. One is to thank all of our annual sponsors, the firms you see on the screen. Without their generous support, both financial and thought leadership support, we can't possibly do all of the professional learning events that we do throughout the year. So if you are joining today's webinar and happen to work for RBC or DGI or Naveen or any of the other firms you see here on the screen, thank you and thank your firm for making things like this possible. One more thank you, and this one goes to CFA Institute. Back when the pandemic hit in the spring, our good folks at CFA Institute reached out to our society and societies around the world and asked, would you guys kind of like to have a Zoom meetings license so that you can keep doing what you need to be doing during the pandemic? And we said, yes, thank you very much. We would be thrilled to take you up on that offer. So the reason we have a Zoom meetings license right now is thanks to CFA Institute. So I am going to stop sharing my screen right now so that Ivana can start in just a moment. Really quickly, the only housekeeping rule today is that we're going to be trying to use the chat screen, the chat function, to enter questions, to ask questions of Ivana and Ken today. We will see how that goes. It seems to work on other webinars we've done. So we'll keep our fingers crossed that I don't screw something up. So with that, I could go into Ivana's and Ken's bios, but I suspect you guys probably already did that when you registered for the webinar. So I'm going to give them all of the time that we possibly can give them and get out of the way. Thank you again, Ivana. Thank you again, Ken. Take it away. Oops, Ivana, need to unmute.
Forgive me. Let's try one more time.
It's okay.
I was just saying thank you so much for allowing us to be here today. Ken and I are very thankful for any opportunity we can to spread the good word about the highlights of the 2020 GIPS standards. We've got a lot of stuff to cover, but we'd like to kick it off with an interactive session and some polling questions. We promise this is not a quiz or a test, but we'd like to get to know you a little bit better. So our first polling question: which part of the industry do you work in or specialize in? Feel free to select whichever ones you may choose that most appropriate to you and or your firm that you work for. We'll give this just a few seconds, and Mark, our host, will be monitoring the results and we'll be able to share them with the audience today. How are we doing, Mark?
Almost all there. 5 more seconds, folks.
Sounds great. Thank you.
And we have a couple of shy people, so we're going to go ahead and end the polling.
Fantastic. And my background, even though it is not live, it's a Zoom virtual, it is very reminiscent of what I am experiencing today. Very windy, sunny. I don't live at the beach, but near enough to it. And the waves definitely are crashing today.
So Ivana, I don't know if you can see the results or not, given that you're sharing your screen.
I cannot see them.
Okay, so it's a mix, predominantly traditional investment managers, but we've also got some folks in private wealth and in performance and risk analytics, and we have another. So
fantastic. Well, this is wonderful. Well, definitely you are at the right session. We welcome you all, and hopefully you'll learn a little bit from today's session, but we're very happy to take any questions throughout the event and or afterwards. So I'm going to pass this along to Ken as he's going to initiate our presentation. Thank you.
Great, thanks Ivana, and hello everyone. So we're all honored to be with you all today. I'd like to thank CFA Society Minnesota, Mark Salter, Megan and Diane for having us here today. It's a real honor to be with you all. This is a continuation of what we have been calling our 2020 GIPS tour, which we started over a year ago. And we obviously we started doing these in person, but given the current environment, we moved to virtually. Hope everyone's staying safe out there. Just wanted to mention that we kind of take a middle of the road approach there. You'll see some technical things within the presentation. Some of the people we present this to, quite honestly, think it's too technical, whereas others think it's not technical enough. So hence the the middle of the road approach. There'll be no quiz, and we'll get you a copy of the presentation likely tomorrow. So you don't need to worry about taking notes or that type of thing. We'll even go over resources that are available to you. So you'll have the slide deck that you can use in the future as a resource. You'll see what resources are available to you. And even more importantly, if you have any questions down the road, whether it's 2 months from now or 2 years from now, we're not going anywhere that we know of. So feel free to reach out to us and we're happy to help you out. I'm going to take myself off on a video so I'm not distracting, and then we'll come back on video later, likely for the Q&A. So what are the GIPS standards? The CFA Institute Global Investment Performance Standards are investment industry standards for both calculating and presenting historical investment performance. The standards originally were meant for prospective investors. So some people like to think of that in the advertising context. It's one of the more successful things we've done at CFA Institute, believe it or not, in that 24 of the top 25 and 86 of the top 100 global investment management firms, either in whole or in part, have chosen to adopt the standards. But I don't want you to think that the standards are just meant for the bigger or the more well-known firms in the industry. In fact, around 1,800 organizations spread across 48 countries have chosen to claim compliance with the standards. And the vast amount of those organizations are actually small to medium-sized firms, because they feel it provides a tremendous benefit to them. And if anything, allows them to compete with the larger firms on a fair basis. And so that's why they've chosen to adopt the standards. As you'll hear a little bit more today, many asset owners and their consultants, and if you fill out many of the investment databases out there, you'll know, inquire about investment management firms claim a compliance with the standards, and some even require it in order to compete to be on a particular investment mandate. We just don't write the standards by ourselves. We do it through the help of numerous volunteers that all come from the investment management community, investment management firms, asset owners, legal and compliance folks, software vendors, you name it. We, like a lot of things at CFA Institute, have numerous committees, and the GIPS standards are no exception to that. If anyone has an interest, feel free to reach out to Ivana and I. We're happy to talk to you about ways that you can get involved. We also work with many industry organizations, whether they be GIPS sponsors, which we'll talk about in a minute, which comprise over 60 not-for-profit organizations. But we also work with investment management industry organizations, such as those that cater, hedge fund, private equity, et cetera. So we don't go it alone. I'm sure all of you are very familiar with CFA Institute. We're not for profit, we're independent. We don't make any profits from the GIPS standards, and we believe that we're the best suited to lead the profession by administering industry standards where needed, and the GIPS standards are a great example of that. So the standards establish standardized requirements for both calculating and presenting investment performance. And that makes it possible for investment managers to compete on equal footing in all markets. It also enables investors to compare the past performance for a given strategy between investment managers. And we'll talk a little bit later on today about asset owners, but it also has allowed asset owners to fully disclose and fairly present performance to their oversight bodies and stakeholders, as an asset owner can also choose to claim compliance with the GIPS standards, and more of them are choosing to do so. Next slide. Thanks, Ivana. So I mentioned GIPS standard sponsors a little earlier. GIPS standard sponsors are an organization that needs to be a not-for-profit entity that is endorsed by CFA Institute, or approved, I should say, and they basically serve a critical role in their local market, which is to promote the standards and to provide input on the development of the standards from their local market perspective. So basically, they'll let us know any technical issues and things like that, so we can take that into account when putting together this global standard. What may be interesting when you look at this particular slide, you'll see over 40 jurisdictions are represented. And in some of these countries, you'll see it's one organization, typically, but not always, a CFA society that's leading the charge. But in other countries, such as the UK and Italy, you'll see it's a whole host of organizations, because in some countries, we have more than one organization that wants to work with us to promote the standards in their local market. And we think that's great. The more, the better. You don't need to have a CFA charter holder or a CIPM certificate on staff in order for your firm or asset owner to claim compliance with the standards. Similarly, if you're in a country that doesn't have a GIPS standard sponsor, that doesn't mean that you can't claim compliance with the GIPS standards, but it provides a local contact, if you will, for these local markets, because we can't be everywhere. And with that, time for another polling question.
So what is your level of knowledge regarding the global investment performance standards? None, some, moderate, or expert? And Mark, I think we're going to have to depend on you to share the results, please. Now, I will say, oh, wonderful, I can see them. Wonderful. Okay. So it looks like the majority of our attendees are of moderate experience. So that's very, very good news. So I think you will definitely appreciate some of the changes that are coming out. Polling question number 3. Does your firm currently claim compliance with the GIPS standards? If you don't know, I suppose it would be wise to just chat with somebody in your compliance department. Some firms have that distinct separation of duties between compliance and the performance aspect of the business, but
don't worry if you hit yes here. This is just between friends. We're not going to get anyone in trouble.
True. That is also true. Now, I know Ken spent quite a bit of time talking about the countries, and that is actually a good thing because as our markets become more integrated, it's important to know what outside firms are doing besides those in the US. So it looks like our majority of audience is claiming compliance with GIPS. That's good news. And hopefully by the end of the session, it'll shed a little light for those that aren't currently complying, and maybe you'll see a benefit in doing so. Thank you. And now I turn it back over to Ken for some history.
Thanks, Ivana. Yep, we're going to go over briefly go over some history. Some of this you may recall to the extent you may have studied for the CFA exam or the CIPM exam as well. The idea for the standards actually started in 1986, 1987 timeframe, and the conversation started because there was a well-known, I would say medium-sized firm in the New York City area. It was taking out advertisements in publications such as the Wall Street Journal. I think Barron's was another one. And she dug out a copy, and on the heading it said, on one of the ads, what does it take to produce annual compound growth of 21% for 21 years with a big question mark? The answer, a genius for managing money. And then there's this chart, and you could just envision it, that has the firm's performance for a period of time, and just envision basically a graph that goes through the roof. And then the S&P 500, and envision that just going across the page, almost constant, not going up at all. And that prompted a lot of discussion. In fact, this firm, and I'll give you some reasons why in a second, got in trouble from the SEC because although they don't have specific rules on calculating and presenting performance, at least back then, outside of regulated investment products, so think of mutual funds, the way they did their advertisement was very misleading. And that's really what prompted this conversation. Why don't we have specific industry voluntary requirements that the SEC isn't going to do it on calculating and presenting returns? So one of the things this firm did was that the performance they presented as their own excluded any historical performance for accounts that they lost. You could argue that was cherry picking. So one of the reasons why they likely lost some accounts was because they underperformed, but you wouldn't know that from looking at the graph. The other thing that they did was I believe they presented performance on a gross fee basis, whereas none of their clients would be able to invest and achieve those returns without paying any fees. And that really was, like I said, the impetus for putting together a set of standards. This happened when we were known as AAMR, before we were known as CFA Institute. And so the first standards, you may have heard of it at the time, came out in, they were effective in 1993. There was a blue book, I don't know if any of you remember, and then there was a white book. And it was called the AMR PPS standards. And it was originally intended for the US and Canada, but the consultant community quickly embraced this, and it became so successful. We had charter holders and non-charter holders in other jurisdictions in countries like Japan and the UK really wanted to join us and adopt the standards, and they weren't sure how they could do that. So they first did it by coming out with their own country versions of the standards. And so we had quite a few of them, not over 40 in terms of the number of sponsors we have now, but a fair amount of country versions of the standards. And they had to go through an approval process. Some of them were a little different from the AMR PPS standards. And we realized, the way to go was really one global standard that any firm can follow regardless of where they are located. So we changed from a local approach to a global approach. In the US, that meant that we converted over to the Global Investment Performance Standards in around 2005. Believe it or not, this may surprise you if you took a look at the current version of the standards, but the first edition of the GIPS standards was only like, 17, 18 pages long. At the time, it was really thought of as principles-based as opposed to rules-based. A lot of the performance people, as they got involved, had, I would say, accounting type backgrounds, or thought like accountants, and they really wanted prescriptive rules for all sorts of things. And that's really one of the main reasons why the GIPS standards have grown over the years since the first edition. The next edition was 2010, and as you'll hear about today, then 2020. Don't think that we automatically come out with a new version every 5 years or every 10 years. That's just kind of the way it's been, although people may have expected it. We don't have to. It's basically our philosophy or our thought process as we come out with a new edition when we think it's needed by the marketplace. And as you'll see in a couple of minutes, that doesn't necessarily mean that we have to update the whole standards at one particular point in time. We could just do part of them in theory. So next slide. So one question that we often get asked is, are there standards required by anyone? What are the involvement by regulators? Well, CFA Institute, we're a standard setter in this area, but we're not the regulator. So we don't have the authority to require firms be in compliance with the standards. The regulatory authority, however, can mention us in their rulemaking. And what many of them do, particularly in the US is a good example, is that if they see a firm that claims compliance with the GIPS standards, when they do an examination of that firm, which could be once every 5 or 6 years, it really depends, they could choose to look at investment performance. And if they come to find out that you're not in compliance with the standards, that would be a regulatory violation because you've made, it's viewed as false advertising, basically. You made a disclosure that wasn't true. And so there are some enforcement actions, not a lot, in the US that mention the GIPS standards because firms falsely claim that they were in compliance with the GIPS standards. Usually when the SEC comes in, if they find something wrong, it's they'll issue you something as part of your deficiency letter. It doesn't lead to an enforcement action. Those are usually in the most egregious cases, and in cases where the firm is also doing a lot of other things that are really, that's pretty bad. Recently, you may have heard, going back to last year, the SEC issued proposed update to what they call their advertising and solicitation rules that hadn't been updated since the 1960s. They originally came out in 1940. And we were really ecstatic to see that they mentioned the GIPS standards in that proposed update something like 22 times. And so, that tells us that, unofficially they've embraced the standards and they're looking at the standards. And in fact, in many of the questions that went out to the public comment, in that public comment document, they asked things like, should we be consistent with the GIPS standards in this respect, or we don't cover this item, but the GIPS standards do. Should we cover this item in our advertising and solicitation rules? So we thought that was a great endorsement by the SEC, if you will. Next slide. Okay, another polling question. And while waiting for that to come on the screen, as Ivana says, given the number of people we have, we don't have to wait to the end to do Q&A. So if you got any questions, feel free to just put them in the chat box and we'll try to address them as soon as we can.
So the question is, prior to this webcast, were you aware of the recent update to the GIPS standards? Now, ultimately, as we await the results, Ken gave some interesting history. So I love hearing it. I never tire of it because it really reflects on where we came from. And as someone wisely said many years ago, you really can't move ahead unless you know where you came from. So the whole history, the evolution of GIPS standards is quite impressive. Oh, how wonderful. 75% of our audience today has been made aware of these updates for the release of the 2020 standards. So that's fantastic news.
Indeed, good news. So thank you for that. Maybe many of you know this. So, you may ask, some of you may ask, if 1,800 firms comply with the standards, why are you updating the standards? What happened that you needed to update the standards? Well, we found that the industry was changing, particularly with respect to the alternative asset class. And we've met with many investment management firms, volunteers, and industry associations in that area to really find out what they thought we needed to improve upon, what we got right, what we got wrong. And so we wanted to better address that. Unfortunately, I would say the number of alternative managers is not as high as we would want that comply with the standards. So in that 1,800, there's some, but there's not a lot. There's a fair amount of real estate firms, some hedge funds and private equity firms, but not a lot. And we really would like the industry in those areas to get on board and adopt the standards. And so we spent a lot of time updating things to better address alternative investments. Also, we wanted to better address pooled funds. When the standards came out, they really weren't mentioned. They weren't, I should say, they weren't geared towards pooled vehicles. They were meant really for separate accounts. They weren't geared towards, let's say, not to pick on Fidelity, but like a Fidelity Magellan fund, where it's a 40 Act fund, it's highly regulated. They're already getting the materials that are required from the SEC that provides them the necessary information to make a basis for whether they to help them in their investment selection process. And so it really didn't make, you could argue that it didn't make sense historically as we had required firms to put a fund in what's called a composite, which I'm sure Ivana will talk a little bit about later, when they're just marketing the fund. And we had historically required them to do so. And also the GIPS report for that composite, frankly, how are you going to get that into the hands of a Magellan shareholder? You really can't. And so we really wanted to acknowledge that and come up with better rules in the fund area. I mentioned asset owners earlier. We wanted to have rules specific for asset owners, and just to, we periodically come up with updates to the GIPS standards, and we wanted to incorporate those updates into the standards themselves. Next slide. Great. So what we had done historically was when we wanted to update the standards, we would just come out with an exposure draft and ask for public comment. What we did this go around is we looked at what other standard setters were doing. We noticed most other standard setters took a little different approach. They'll come out with a consultation memo first, basically talking about their intention to update the standards, their particular standards, why they want to update them, and ask for comments as to whether they should embark on that large project. So that's what we did. We came out with a consulting paper in May 2017, and the overwhelming feedback from that was, yes, now's a good time to update the standards, and yes, we agree you need to update the standards to better take into account alternative investments and pooled funds. So we got cracking on that. The exposure draft was released in 2018. We got over 120 comment letters back. Thank you for any of you that prepared a comment letter. Over 5,200 comments were included in those 120 or so letters. And I can painfully tell you that every comment was evaluated. We put together by topic these Excel spreadsheets that would basically summarize all the comments. All us got involved within the Global Industry Standards team as part of CFA Institute staff to recommend whether we should take that particular comment or not. We forwarded on our recommendations to our volunteer GIPS committees that I mentioned earlier. They agreed with some of our recommendations. They disagreed with others. And then we had a consensus as to the changes that we wanted to make. And then we made those changes, and they've incorporated into the final 2020 GIPS standards. So one of the key things I want to point out is we definitely not only take into account industry input and putting together the standards, we also listen to the industry in terms of taking comments and making changes as needed. And that's evidenced by the final version of the 2020 standards. If anyone has an interest in what the major comments were, and so really what the issues were and our conclusions on them, in addition to the standards themselves, we've released what's called an adopting release, which is on our website. And that provides insights into the major decisions and the conclusions that we reached. So, from a public disclosures transparency standpoint, anyone could see that. Also, all the comment letters are on our website, with the exception if anyone asked us not to provide it on our website. The vast majority of firms don't have an issue with the comment letter being on our website. So those are available publicly to take a look at as well. So what you see on the screen is what basically the layout of what it looks like, the new edition of the 2020 GIPS standards. The first thing you may notice is now there are 3 chapters. I tend to call these books. If you were to see the hard copy, and if we were in person, I'd show you the hard copy, and there are physically 3 books. Currently, it's just 1 book, and that is applicable for both firms and asset owners. And then currently we have verification guidance, and we'll talk about verification in about 20 minutes or so. But our verification guidance was quite honestly all over the place. And so we wanted to consolidate that into 1 chapter, if you will. These are available for free for download on our website via Adobe PDF files. So you don't have to go out and get a hard copy. For those of you that want a hard copy, before the pandemic, I'd mail you some. Now, basically, you can order it through our website. There's a link to Amazon for a real nominal charge, and you can get the hard copy. But the real key here is they're sufficient. So if you're a firm, you just look at the GIPS standards for firms. If you're an asset owner, you just look at the GIPS standards for an asset owner, what have you. Each stands by itself. Each has a glossary and exhibits and that type of thing. And the other beauty of this is if we choose to update the standards at some point in time, and let's say that update is only applicable for asset owners, we wouldn't need to touch the GIPS standards for firms. We'll just update the GIPS standards for asset owners. Not like we're going to take over the world or anything, but if we decide, let's say, to have a GIPS standards for OCIO managers, we can do that by having a separate book for that. And again, we wouldn't have to touch the GIPS standards for firms and asset owners. So hopefully that this new layout will make a little more sense and make it easier for us, in fact, to update the standards. Another real valuable resource that's available to you is what we're currently calling the explanation of provisions in the 2020 GIPS standards. We used to call that the GIPS handbook. A lot of folks in our industry use this as an investment performance resource, regardless of whether they choose to comply with the GIPS standards. And basically, for each section within the GIPS standards, it talks about provision by provision, the purpose of the provision. Depending on the nature of the provision, it will likely provide examples, and it could also provide Q&As and exhibits to help you comply with that particular provision. It's pretty lengthy, but firms find it incredibly valuable. It's kind of like their encyclopedia or guide to understanding the GIPS standards. So I highly recommend it if you haven't taken a look at it. Due to the demand in coming out with this, we've been releasing it as it's been completed, section by section, both within the GIPS standards for firms and the GIPS standards by asset owners. All the GIPS sections have now been completed explanation-wise, so they're all out there. They're all available on our website. If you want a hard copy, again, just like the standards themselves, you can order it through our website from Amazon. We're also going to post really shortly a file that's got all the explanations for firms for all the sections in one file. Right now, you'll see them laid out by a file for each section. And then another thing that we did this go around that we hadn't done it historically, to the extent anywhere in these explanations, we have a mathematical example. We've now provided an Excel spreadsheet So you can see how we derived that particular calculation, so you're not sitting there struggling and trying to figure that out. We even have a comparison table that compares the reporting requirements by type of report. And we do that both for the GIPS reports for firms and the GIPS asset owners reports as well. So we think this is great in terms of the resources that firms and asset owners need to comply, but we're open to getting any feedback and hear from you to the extent you feel that you need any additional resources. We always feel like we're here to help.
Thank you, Ken. Ken's done a great job in trying to give us a little bit of the history and the background behind the CFA's Institute's rationale for creating what we currently have enjoyed as the GIPS standards. With the release of the 2020 GIPS standards, there's some nitty-gritty details that I'm hoping in the next few slides I'll be able to really hone in on as to where the changes are taking place. Specifically, I want to just remind you, GIPS is really all about full disclosure and fair representation. Fundamentally, that did not change. And that is quite key, as I said earlier with the explanation of the country sponsors. We are a global player now, whether we want to be or not. And therefore, despite the fact that our languages may be spoken in different tongue, the results as investors compare one to another really need to be reflective of the same underlying data. And I think that's where GIPS strengths come in. So as we get down into the details right now about the release of the 2020 GIPS standards, this next few pages will break it down for us. Starting with the general provisions. As Ken alluded to earlier, this is the details, the fundamentals of compliance, the data and calculations. With technology at our fingertips, it's only made it easier for us to fully understand exactly how to derive some of the details. And the composite and pooled fund maintenance. Now, the pooled fund, I think we're going to learn here that really is key to some of the intense focus of the new edition. GIPS composite reports. You'll see here now we've always known about time-weighted rates of returns, and now we're introducing the money-weighted rates of returns. Not that it's new to us, but now GIPS is allowing it to be disclosed, which is new to the standards. And then we talk about GIPS pooled fund reporting, also accepting both types of returns. And then finally, the GIPS advertising guidelines, which is quite key if you choose to report or advertise GIPS in your terminology, then it needs to comply with the guidelines of advertising. There's a glossary, and I guess this would be a great time to introduce that English is not my first language, so sometimes I hesitate since I'm trying to struggle with the proper word. I frequently go to the glossary because I find it to be a perfect resource as far as understanding the definitions of a word. And this particular glossary is quite in depth. And then in the appendices, we have several samplings, what I believe, in my opinion, to be a bit more robust than the samplings that were previously provided. So there's a little bit out there to show for a variety of different scenarios that an investor, or in this case, an investment manager would want to replicate. Some of the definitions, as I mentioned, which is also indicated in the glossary, is these very specific terms that you have to fundamentally understand. Segregated account, a portfolio owned by a single client. Now, why is that important? Well, because it distinguishes the concept of the pooled fund client or the pooled fund portfolio. And now we are showing here, there's two unique pooled fund options. You're either a broad distribution pooled fund or you're a limited distribution pooled fund. And the difference strictly being what's available publicly, basically, and what's not so public, as in the examples of limited partnerships and private equities. The reason why, again, it's important to distinguish these is because pooled fund accounts and portfolios, Ken mentioned this earlier, really has become so overwhelmingly regulated by various institutions out there, like the SEC here in the US, and you have your UCITS in Europe. But to the investor, really, we wanted to highlight the simplicity of some of the data that really needs to be focused in order to compare one portfolio to another. Composites versus pooled funds. Composites, well, let's start with the definition. They're required, composites actually is a grouping of various portfolios, specifically to avoid that very early onset issue that started the whole process of developing GIPS today, and that is the elimination of cherry picking portfolios. So once you've created your composites, composites are required for strategies offered in a segregated account format. So just like separate accounts or segregated accounts had to be included in at least one composite, pooled funds must also be included in at least one composite, assuming they meet the composite definition. A firm is not required to create a composite that only includes one or more pooled funds unless the firm offers the strategy as a segregated account. So what this means is we could either have the pooled funds in the composite, or we can create it as a standalone document, and we'll describe what that document is called in a few minutes. And then firms may terminate a composite created to include one or more pooled fund if the composite is not representative of the firm's strategy. And this really, conceptually, again, not different from the past. You can open and close composites, you just have to then define what it is you're doing. Here's where we get into the specific uniqueness about 2020. So right off the bat, we're calling it GIPS reports. Formerly, it was considered a compliant presentation. Well, we're nixing the words compliant presentations, and we're going to focus on what it is. Well, we are providing GIPS reports. GIPS reports are broken down into two unique reports. Either it's known as a GIPS composite report, which is a presentation of a composite that includes all of the information required by GIPS standards, or you're presenting a GIPS pooled fund report, which is, as in the name implies, it's all about the pooled funds. GIPS report is the combination of those two, so you can refer to them in either of those terminologies going forward. The presentation of gross only returns, net only returns, or both returns is of the firm's choice, subject to the regulatory requirements. Again, GIPS is not telling you one is better than the other. That's up to the firm to decide how best to present their returns, always being mindful of properly labeling everything. And on the right side is an example of a typical GIPS report that is to be included going forward. Providing GIPS reports to prospects. Well, again, here, ladies and gentlemen, we're not changing this. It's always been a requirement to make available with every reasonable effort a GIPS report to all prospective clients at least once a year until they become a client. Hopefully they all become clients. With the introduction of limited distribution pooled funds, this is where it gets in a little unique. Firms must make every reasonable effort to provide a GIPS report to all prospective limited distribution pooled fund investors when they initially become prospective investors. So a GIPS report may either be a GIPS pooled fund report for the respective fund, or it could be the GIPS composite report, assuming that there isn't a pooled fund option to offer. Once the firm has provided the GIPS report to a prospective investor, the firm must provide an updated GIPS report at least once every 12 months until that prospective investor becomes a client. And that's no different than a separate account. And then the same would be true of our broad distribution. The firms may provide a GIPS pooled fund. I just want to bring to your attention, there's the very unique four-letter word that is very prominent here, and that's the word must. Be attentive to that, because that's some of the changes that's being presented, that things that may have been recommended in the past now must be a part of the process. So in the case of the broad distribution, the firms may provide. So again, that distinction is there for you to pay attention to going forward. Another unique change between the two versions: transaction costs, formerly trading expenses. In the 2010 edition, trading expenses indicated actual trading expenses incurred during that time of whatever data you're presenting. Unique to 2020 is that the firms may use either actual or estimated. So here the word estimated is quite new, was never accepted before, but now 2020 is permitting estimates of transaction costs to be included in the composites. Be mindful that estimated transaction costs may be used only for those portfolios for which actual transaction costs are known. So you can't make up numbers, but you can estimate numbers that you believe are to be true to the management of that portfolio. External valuation. So in the 2010 edition, with real estate, and I'm not going to spend too much time because I don't believe anybody indicated that as a field of interest for today's session. But one of the distinctions is that in the 2010 edition, external valuation for real estate must have an external valuation at least once every 12 months. That is still the same, but now you must have an external valuation at least once every 12 months. And then it goes on to describe the real estate investments that are not real estate open-end funds. So it's distinguishing between just the managing of real estate and managing of the real estate, the real estate funds that are out there available. So this kind of puts it a little bit into some distinct details.
Sorry, Ivana. I was just going to jump in there. The reason that is because on the open-end fund side of real estate, and this has changed somewhat over the last 10 years, but investors are really demanding external appraisals. In some cases, even more frequently than annually. That's really standard industry practice across the globe. And so the real estate industry really wanted us to recognize that. So we made this kind of more stringent, if you will, in going from 2010 to 2020. But for non-open-end real estate funds, so that's basically going to be closed-end funds and segregated real estate accounts, there's an increased use of opportunistic real estate, where arguably, this is always subject of a debate, externals aren't as valuable as they are for core, traditional real estate. And that's why we loosened up the external valuation requirement a bit for the non-open real estate funds.
Thank you, Ken. Thank you for interjecting that. I appreciate it. Moving on to time-weighted versus money-weighted returns. A topic of debate in many, many conferences and many seminars in the past. And I guess it will continuously be debated upon which is the better one. But I really do believe that you have to put yourself in the right shoes in order to determine what works best for you. what is being said by the 2020 edition is that the firms must represent the time-weighted rate of return unless certain criteria are met, in which case the firm may present money-weighted rates. The firms may choose to present money-weighted rates versus time-weighted rates if, for the composite or pooled fund, the firm has control over external cash flows, and each composite portfolio has, or the pooled fund has, at least one of the following characteristics. It is closed-end, it has a fixed life, it has a fixed capital commitment, or illiquid investments are a significant part of the composites or pooled funds investment strategy. So if any of these traits are existing, then you may choose to consider money-weighted rates more valuable to the investor than a time-weighted rate. But in every case, time-weighted rates should be used. Money-weighted rates of returns in the 2010 edition, it was more commonly associated with the since inception internal rate of return. And it was also quite unique on the private equity side. I think that's where you saw it most appropriate. In the 2020 edition, the money-weighted rate of returns, the GIPS reports that include money-weighted rate of returns are required to include those returns for only one period, from inception through the most recent annual period. So it's not like you have to do in a sampling of a traditional GIPS report where you show annual returns. If you're doing money weighted, you just need the since inception return. In 2020, composites and pooled funds that use a subscription line of credit and present money-weighted rate of returns must present money-weighted rate of returns both with and without the subscription line of credit activity. So this is definitely a little bit more detail and nothing that you have to memorize at this point. As Ken shared with you earlier, you will be given the presentation so you can refer to it at your leisure.
And if you don't mind, Ivana, we often get the question, well, why did you say money weighted returns? Why did you move away from IRR? The prior version of the standard said IRR. And I respond to that in a couple of ways. One is on the time weighted side. We never really said that you had it was a particular method that you had to follow. We said time weighted that meets the following requirements. So we're kind of consistent with that now on the money weighted side. Most, if not all firms we recognize would use since inception IRR as the methodology to meet money weighted returns if they so want to choose that. And in a lot of alternative investment areas, money weighted return is the methodology that they want to use. So they'll be able to use that now going forward. In theory, you could do what we call a modified Dietz calculation without linking, and that would be a money weighted return method. But I haven't seen anyone done that. And again, I think IRR is still really the general industry accepted method for to meet the money weighted return requirement.
Well, and I work in the more traditional investment management organization, and the reality there is time-weighted rate of return best suits us because we have no control over the cash flow. I always think of consultants and plan sponsors that have control over those cash flow would most likely benefit from the money-weighted returns versus the time-weighted. But again, you have to take the circumstance and you have to be able to, one, either provide both or to understand what the requirements are.
Yeah, and I'll just add, you mentioned plan sponsors. Outside of the GIPS standards, it's sometimes a point of contention because, you can have a private equity or a real estate firm that says, they need to evaluate us. It should be on a money-weighted basis, not a time-weighted basis. This is how we make investment decisions, and this is what you're going to get from us. Whereas the plan sponsors, like, that's nice, but these returns roll up into our pension plan, or our pension plan as a whole are done on a time-weighted basis, give us the time-weighted returns. So we find there's there's often, like I said earlier, a point of contention between the manager and the plan sponsor as to what they want. So even though we allow money-weighted returns, the sponsor may still ask for time-weighted, or they may have their record keeper calculate time-weighted, even though the external manager may be providing money-weighted returns.
Valuations and return calculations. This is a very nice reference tool with time-weighted rate of return indicated how often the valuation requirements are. And you can see, obviously for portfolios in composites monthly at minimum, private markets quarterly at minimum, pooled funds annually at minimum. So this is a really nice reference. Again, each segment will have to evaluate what best suits where they fit into which block here. But given our time, I want to just continue on real quickly and talk a little bit about total firm assets. So firms must present total firm assets. Again, not a new concept. We've always been doing this. Now it's being spelled out a little bit more granular, and that's discretionary portfolios at fair value plus non-discretionary portfolios at fair value equals the total firm assets for which the firm has investment management responsibility. Key words there, investment management responsibility. Why? Because advisory only assets cannot be included in the total firm assets. So keep that in mind. Uncalled committed capital cannot be included, must not. I probably should use the words here, must not be included in total firm assets for periods beginning after January 1st, 2020. And no longer an option is to present composite assets as a percentage of total firm. Instead, the total firm's asset must be presented. So that's new. Before you had an option, now you don't. So keep that in mind. Oops, so sorry, forgive me. Portability, often discussed in many roundtables. When a compliant firm acquires a non-compliant firm or affiliation, the firm may present the acquired firm's track record as its own. On a composite specific or pooled fund specific basis. If, and only if, substantially all the investment decision makers are employed in the new organization, decision-making process remains substantially intact and independent. Records to support the performance are from the acquired firm. So again, those records are a key. If you don't have the records, even in the existing firm, you can't report as being compliant with GIPS standards. The firm may link performance if, in addition to the above, there is no break in the track record. Very, very, very key, because you can't link if there's a few days missing or a few months missing. And assume that you could just fill it in with a 0 or with an index. I've heard people do that. That is not an option to be compliant with GIPS standards. So if there's no break, you can link them and port over all the history. And there is no time limit on when firms may port history from the past. So that's good. I do believe that there was a time limit historically, but now you can port the history with no time limit. Assets of the acquired non-compliant firm or affiliation must meet all the requirements of the GIPS standards within the 1 year. So that hasn't changed. So everybody's got to be on the same page if the new company or the acquiring company wants to continue to claim compliance with GIPS. There's 3 pages here, as indicated by the header here. Unique required disclosures. Claim of compliance, you must read it. It's a slightly different language. I didn't put it in here, but it is on the presentation, or formerly the presentation, now the GIPS report. You must, in order to comply with the 2020 GIPS standards, you must restate your claim of compliance. Specifically if your firm's being verified. The inception date, this is a new requirement previously, we only had to show the creation date of the composite, but now we have to show the inception date of the composite or the pooled fund. GIPS trademark. Oh, I want to just take a few seconds here and say the word is GIPS. I've heard a few people over time referring to it as GIPS. It is GIPS, and specifically, it's the 2020 GIPS standards, which is what we are presenting here. With that said, the CFA Institute took this quite seriously, and they trademarked the GIPS acronym, so that now you have to disclose this little verbiage here on all your presentation, on all your reports going forward. Risk, there's a new disclosure here that needs to be brought to your attention. When calculating risk measures, you need to state whether or not it is using gross or net returns. Previously, I think people just defaulted to gross, but I think the industry does allow for net returns to be used, and that's fine, but now you just have to state it for the record. In addition, you need to describe the risk measure and the risk-free rate that's being used as well. So, for example, if you're reporting a Sharpe ratio, then you must reflect which type of risk-free rate you're using in order to calculate that particular statistic. Revised disclosure, well, this is good news. You no longer are required to disclose the 3-year annualized ex-post standard deviation is not presented because 36-month monthly returns are not available unless the composite or pooled fund has at least 3 annual periods. Well, that's good. I mean, that kind of made sense, right? If you don't have the 3 years, there's no reason to stipulate you're not showing something because it's missing 3 years. So it's kind of understood. Oops, forgive me. We have a few things on the real estate that you should be aware of that's revising the disclosure along with leverage, derivatives, and short positions. There's a brand new disclosure, how they may be used or must be included in the composite description. I want to bring to your attention return types. There's a new disclosure there. If the return has changed, specifically if you were reflecting time weighted to money weighted, you have to mention it. Estimated transaction costs, I shared with you that was a new to 2020 GIPS. And if you are going to be estimating transaction costs, it is strongly suggested, and actually it's required, that you indicate how you came about those transaction calculations. And new disclosure for fees, if you're using a model fee investment schedule, then and to calculate your net of fee returns and gross of fee returns are not presented, then the model fee used must be as of December 31st, 2020. Theoretical performance, oftentimes known as simulation, sometimes it's hypothetical, but in this case, they all say, referring to the same thing. We're calling it here for this presentation, theoretical performance, if presented on the GIPS report, must be presented as supplemental information and must disclose that the results are theoretical and not based on performance of actual portfolios, must disclose that the theoretical performance was derived from the retroactive or prospective application of a model, that a basic description of the model and assumptions used to calculate the theoretical performance sufficient to the prospective client or prospective investor to interpret the theoretical performance. Back-tested performance hypothetical. Here's all the different naming conventions that you can use. No matter what you call it, you can't present it on the GIPS report unless it is considered, it is indicated as supplemental, and it has to have these disclaimers on it. Sunset provision. Well, certain disclosures must be included for a minimum of 1 year and may subsequently be removed if the firm determines that the disclosure is no longer relevant to interpreting the track record. Examples are significant events that would help a prospective client interpret the GIPS report, any changes made to either the composite name or the pooled fund name, any retroactive changes made to the benchmark, any correction of a material error, any change to the type of return presented. Sunset provisions. There's a reference as well on the GIPS website where you can use, there's a matrix out there for anyone to refer to. These are just some examples of what would be considered a disclosure that would be up to interpretation, whether or not an investor would be confused, specifically if you're giving it to a prospective client within a year and you have to give them an update. Well, they want to see what changes you've made, and that's why these sunset provisions are there. But after a year, certain provisions like a name change may not be appropriate if it may actually cause confusion. So having the sunset provision definitely is valuable and helpful to all of us on both sides. And now we're up for our next polling question, our last one for today. So please answer the following question. Prior to this webcast, were you aware of any recent change? Oops, that's not it. Was that it? I think it had to do with advertising. Yes. Does your firm advertise performance results? And if you haven't guessed, there is one more provision that I want to talk about, and that's GIPS advertisements. And hopefully it'll be quick, as we want to just bring to your attention a few minor changes that are being introduced. And as we see the results in a few seconds, then we'll turn this over. So the majority don't advertise performance results. Okay, that's fine. You don't have to. I think people can take one of two positions. If they decide to advertise, you actually have three options. You don't have to. You jump down to option 3, and if you don't mention that you're GIPS compliant, then you don't even have to worry about the advertising guidelines. If you choose to share performance and indicate that you're complying with GIPS standards, then it is pertinent that you review the guidelines so that you can do so without being pinged by a regulatory agency such as the SEC for not following suit. So with that, I'm going to turn this back over to Mr. Ken.
Thanks, Ivana. So asset owners play a really important role with respect to the GIPS standards. Many investment managers will interact directly with asset owners through the RFP process or indirectly through their consultants via the consultant questionnaires and consultant databases and industry databases and so have you. And as I mentioned earlier, in many of these forums, if you will, investment managers are now asked whether they are in compliance with the GIPS standards, and sometimes it's now required. And that's really one of the things that's really driving compliance with the GIPS standards. And we're really looking to asset owners, even if they choose not to comply themselves, to at the very least inquire of their third-party managers, to the extent they don't manage money in-house or just in-house, about compliance with the standards. And we think that's one way that we'll see an uptick in the compliance levels of the alternative investment managers. Asset owners themselves are a little different, and that's why we have now, the GIPS standards for asset owners. So one of the major differences is they don't have prospective clients. At least most of them don't. There are some exceptions, but typically they'll report to an oversight body. Depending on the nature of that asset owner, there could also be beneficiaries and a plan sponsor and that type of thing. So when we say asset owner, next slide, please. What do we mean? So some good examples of that are pension plans, endowment funds and foundations, sovereign wealth funds, even insurers and reinsurers. Some examples of asset owners that have claimed compliance with the standards a big name you may have heard about, CalPERS, now claims compliance with the standards. Where I live in Boston, the big sponsor is MassPrim, which has recently started to claim compliance with the standards, also STRS Ohio. Some other examples outside of the US off the top of my head, in the Middle East, the huge sovereign wealth fund, SAMA, Saudi Arabian Monetary Authority, Norges Bank in Europe, up north, and our Canadian neighbors, CDPQ, outside of Quebec, which is a pretty huge plan with a lot of alternative investments. They're now actually, they've been claiming compliance with the GIPS standards for quite a while. They were actually one of the first asset owners to claim compliance. So when we refer to an asset owner, it's probably obvious by those examples, but it applies to the organization and not a particular individual. If an asset owner was to hold itself out for new business, which they could, given the expertise that they have in managing their plan, then they would comply with the GIPS standards for firms, but otherwise they would typically comply with the GIPS standards for asset owners. The asset owner report, next slide, is a little different than the GIPS reports Ivana showed you from firms, in that you're only required to present what we call the total fund. So think about that as like the plan as a whole, like the asset pool for the pension plan. You're not required, but you can, if you like, choose to present composite level, think strategy level performance by asset class, but you're not required to. We made a pretty big accommodation to get asset owners on board when we updated the standards for 2020. And the biggest accommodation was for asset owners that initially come into compliance. We're allowing them to come into compliance by just showing, or going back, if you will, 1 year of history, which is very different than for firms, where you must go back at least 5 years history-wise, and then you build up to at least a 10-year track record. So the 10-year track record still exists for asset owners, but you can get into compliance, or to make it easier to get into compliance, you can start by just showing 1 year of investment performance. The reasons an asset owner comply are very similar why a firm would comply. It helps ensure that the asset owner's investment performance is complete and fairly presented, regardless of whether those assets are managed internally or not. It demonstrates that asset owner's commitment to follow global industry standards, and also the commitment to adopt the same principles that they may require of their third-party managers. And obviously, by complying with the standards, you're taking a look at your policies and procedures. You're probably enhancing them, and that's a good thing. Something that may cut down on errors going down the road. Many fiduciary, or I should say, many of one of the reasons why some of these asset owners have chosen to comply with the standards is because their fiduciary board actually thought it was a good thing and directed them to comply with the standards, which is an interesting point. So we keep referring to the new version of the standards as the 2020 edition of the GIPS standards. So let's just take a second to talk about the effective date, regardless of whether it's a firm or an asset owner. For input data, which is really calculation inputs, you have to comply as of January 1. For most firms that are already choosing to claim compliance with the standards, there's not much of any changes that they really need to make on the input side, to be honest with you. With respect to reporting, however, to make it easier and to allow firms to have more time, the updated requirements for a GIPS report need to be adhered to the first time you're presenting performance for periods ending December 31, 2020 or thereafter. So that means, most of the firms that are complying with the standards, the first time that they're going to be really dealing with the new requirements through the reporting process is going to be in the spring and summer of 2021 when they're preparing their GIPS reports. Of course, if a firm comes into compliance now, they could choose to adopt the new edition. That's what I would do, of the standards just from the get-go. And if a firm wanted to adopt the new edition before it's required, they can, and some have already chosen to do so. Just real quick, moving on along, verification. Verification is optional. It is not required in order to claim compliance with the standards. About 87, 88% of those 1,800 firms that comply with the standards also choose to get a verification. In the compliance statement that Ivana mentioned, you're required to disclose whether you receive a verification or not. And that's, a very big reason why firms and asset owners would choose to get verified, because they don't want to disclose they're not verified. And so when they present that report to their board or prospective investors, they don't want to have to ask the question, oh, why does it say here you didn't get verified? Do you have anything to hide? Why don't you get verified? So that's a real reason why the verification numbers keep going up every year. Verification is done on a firm-wide basis. You can think of it more like a compliance testing type of review. It provides additional confidence that that firm is indeed in compliance with the GIPS standards. You can, next slide please, you can choose once you are verified, or in addition to the verification, but again, no requirements, to have on a composite basis or a fund basis what we call a performance examination. And that is more akin to an audit. And that would opine on the particular performance for that composite or pooled fund, whereas a verification is going to opine on the policies and procedures, whether those have been implemented on a firm-wide basis. Most of the verification, there are requirements in order to be a verifier. You have to be knowledgeable. We don't require that the verifier have a particular designation, but it's typically done by people that specialize in this area, whether it be from an accounting firm. So all the big four, even outside of the big four, do verifications. In addition to that, there's non-accounting firms that have gotten into this area, that specialize in this area. I kid you not, we created an industry. The GIPS standards have been so successful. So there's a whole host of people that provide GIPS verifications and or consulting for a living. In terms of resources, we've got lots of great resources available for you. We have a GIPS website, gipsstandards.org. Right now, this is going to change going forward, but some of the 2020 resources are actually housed on the CFA Institute.org website, but you can still get to them by looking at gipsstandards.org. So no need to worry about that. And going forward, it's just going to be gipsstandards.org, because that's really where, since we've got the brand name recognition, that's really where most people are going to get the information about the GIPS standards. I wanted to let you know that we have a help desk, which not all standard setters do. So to the extent you have a technical question, or really any question regarding the GIPS standards, we've got a team of technical experts that review all those questions, and they strive to get back to you within 2 or 3 business days. If you have a question that we're not sure of the answer, or you stump us, we may run that by some of our volunteer committees and then get back to you. And it could even lead to, and it has in the past, issuing some further guidance on that particular area, because if you're having an issue with something, someone else may have an issue with something as well. The standards themselves, guidance statements, which are buzzword for white papers. We also have Q&As. Those comprise what we call authoritative guidance. Those are all on our website, and easy to find. We also have events that we let people know about, webinars such as this that can be viewed. We have, next slide please, a GIPS standards newsletter, which over 20,000 of your peers subscribe to. And I highly encourage you to subscribe to that. There's a link that tells you how to do that on our website. If you can't find it, just shoot Ivana and I an email. We have gotten into the habit over the last year of providing technical guidance within that GIPS standards newsletter, which we hadn't prior to. And I think that's making it even more popular in the industry, even for firms that choose not to comply with the GIPS standards. Also, we just came out with a new brochure you may be interested in. It's called the GIPS Standards Increasing Transparency and Trust. And this takes the reader through really well the benefits of complying with the standards. And there's pages geared for firms, asset owners, verifiers, etc. It's a great summary for entities thinking about getting into compliance with the standards, but also for entities that are in compliance with the standards, because they can use that as a tool internally to talk about the GIPS standards within their firm. So lots of great resources, and like I said earlier, feel free to reach out to us if you have any other questions. If you're looking to hire a verifier, we even have an RFP document that you can use to hire a verifier. Ivana, do we have any? Okay, so feel free to, if any questions, to use the chat box in our remaining few minutes here. I think if we don't get any questions, we want to talk a little bit about what we're doing with ESG and our CIPM programs. So let me turn it back to Ivana just to talk a little bit about our CIPM program.
So needless to say, I was very excited when the GIPS standards came out. We were a firm that had been complying with AIMR PPS from the onset of its development and prior to. And when GIPS came out, what that did was it really allowed us all to be on the same playing field and compete against other investment advisors that were offering similar skills and results. And most importantly, from a selfish standpoint, it also brought forward the opportunity for performance analysts to become more of consideration as a professional, as opposed to just a back office person just crunching numbers all day. And that's where the CIPM came in. When the CIPM, I believe it was actually, there was another acronym in the early days, but when it came out, it was almost simultaneously in 2005, 2006 to the GIPS, the original edition. And who benefits from the CIPM designation? So clearly, it's a firm-wide professional competency testing. It results in stronger performance evaluation, asset allocation, manager selection, risk awareness, and client communication. It hits all of the bells and whistles that performance analysts may expose themselves to at a firm, whether it be a small organization or a larger organization. And basically, in today's environment, the CIPM program can be segmented into 3 different categories: the performance evaluation section of the exams, the portfolio manager section of the exam, and really now something fairly new over the last few years, the manager selection process, because it's quite vital. We talked a little bit earlier about being able to put yourself in somebody else's shoes. And that's what the CIPM does. In my opinion, I can't be more impressed on the fact that to have gotten this designation allows somebody to be very well-rounded. And it is such a great compliment to the CFA charter holders as well, because there is a lot of overlap. For example, if in fact you need to worry about getting your CFA because it's a requirement or it's a personal goal of yours, objective of yours from a professional standpoint, and you have an interest in calculating performance and knowing the minutia of the day-to-day details of those calculations, it's such a great compliment. At the bottom of this particular screen, you can see how it's being segmented out into the different tasks, so to speak, whether you're an accountant or you're a portfolio manager. There's a little bit of something out there for everybody that really hones in on the CIPM designation, which again goes about that well-rounded individual. The CIPM program, unlike the CFA, which is a 3-level exam, the CIPM is a 2-level exam. All of it is computer-based. It is rigorous, so don't underestimate it. It did take me quite a few years to do it, but I was very, very happy to have had the opportunity of studying for it, and now have been able to be part of the goal setters as well. So I think the examination itself, as rigorous as it is, it's definitely worth the amount of time and effort it takes to go into it. If you are already a CFA charter holder, I do believe level 1 is waived because of the overlap in the content, such as your code of ethics and other information that overlaps it. Investment performance evaluation involves the knowledge and comprehension, the application process, the evaluation process. And basically it really spells it out here as to how much of each of the 2 level exams, level 1 and level 2, how much of that particular knowledge you need to be well versed in, whether it be the performance side of things to your attribution, your measurements, your calculations, and your appraisal aspect of it, not to mention the fact of the GIPS standards. There's a good section on that part, which that section is also part of the CFA Institute. And then, as I mentioned earlier, the new inclusion of the manager evaluation process, which is very key to the success, knowing what an outsider is thinking about. The journey, you have to learn it, prove it, live it. There's just no way about it. You have to learn it. You have to understand it fundamentally. You have to prove it, which is the results of the examinations, and then to live it, to continue your membership. I applaud you all in attendance today because of your active membership with the Society of Minnesota. It's just valuable knowledge, not only as a network opportunity, but to even expose yourself to what else is out there, whether or not you're going to use it on your day-to-day life, or to be able to have a conversation with somebody in the business that you can engage on that. So that whole membership and the career opportunities being involved with the CFA Institute and their local societies is quite prominent. There's some other sources here, and I'll let Ken, who is the expert from the Institute perspective.
Thanks, Ivana. We're running out of time here, so let's flip one more slide over to ESG. By the way, if anyone needs to run on 2:30 or 1:30 your time on the dot, please don't hesitate to do so. Thank you for joining us today. I'm just going to spend a couple of more minutes and talk about ESG, as you can't go anywhere without hearing about ESG. It's a really big hot topic, so I thought I'd let you know about some of what we're doing in this area. If you haven't heard, we've proposed the release of ESG standards, which would be separate from the GIPS standards. Our goal in this area is to standardize disclosure for products with ESG features. We're calling this the disclosure standards for ESG products. And we're hoping, like the name sounds, to standardize disclosures by defined ESG strategy. So these standards are really disclosure based, similar but more so than the GIPS standards. And they're not meant to, from the issuer side, you may hear a lot about the work that's done on the ESG area from the security issuer side. This is really from, similar to the GIPS standards, the investor side or the prospective investor side, to help them make the decision as to what product they want to go into relating to ESG, and ensure it's the right product, and that when they compare 2 types of similar products, that they've got the right disclosures in there. So similar to ESG, we had done, and I can get anyone a copy of this as part of our 2020 investor trust study earlier in the year. We included a question on there regarding ESG, and it was interesting that 19% of institutional investors and 10% of retail investors said they currently invest in products that incorporate ESG factors, but 76% of institutional and 69% on the retail want to invest in ESG. So that tells us there's a much greater demand for these types of products than those investors that are currently in them. And so we think there's a need for these standards, similar to the GIPS standards. Before we embarked on this journey, we wanted to make sure that we were adding value. And quite honestly, we weren't perfectly sure. So we met with a lot of the standard setters that had already, that are in the ESG space, and there's a lot of them. Investment management firms that are big into ESG, plan sponsors, et cetera, to get their feedback as to whether they thought there was a need for standardization with respect to these types of disclosures. And we were told the answer was yes. And so just like the GIPS standards, we came out with a consulting memo, which basically proposed putting together these ESG disclosure standards for investment products. The consulting paper had a public comment due date of August. I'm sorry, it was issued in August. The due date was in the middle of October. Unofficially, we allowed people to submit comments through the end of October. And we got over 100 comment letters, at least so far. And so we're really pleased. It was a really nice, diverse set of comment letters in terms of the types of firms, whether it's types of firms, whether it was a firm, an asset owner, an industry association, even a regulator, as well as the location. We got comment letters from all over the world, so we couldn't have been more thrilled with that. We've started some, just like the GIPS standard side, some volunteer committees, one a technical committee and one a verification committee, as we're looking when the standards come out to have a verification section of the standards. If anyone has any, would like more information on this, I'm happy to set up a call with any of my colleagues that work in this area with your firm or your organization and what have you. We're doing quite a lot of calls to let firms know what we're planning. And I think this is going to be a really good thing. So we've got a timeline I can share with you offline, but we're hoping, within the next year, we'll have the first edition of the ESG disclosure standards for investment products out for public comment. So with that, unless anyone has any questions, I'd like to call that a wrap. We have our contact information that Ivana will share on the screen with you all in a second. Like I said, we'll get you a copy of the presentation, but more importantly, please don't hesitate to reach out to Ivana and I, either now or down the road if you got any questions. And thanks again for CFA Society Minnesota for having us. And over to Mark.
Ken, thank you. Ivana, thank you. And thank you to everybody who hung in there for the full 90+ minutes today. We do not have any questions in the chat function, so either Ken and Ivana have masterfully answered every last question you have on this topic, or more likely it's we've got some shy folks today. So yes, please reach out if you have questions, and watch for follow-up evaluation and links to the slide deck and all of that kind of good stuff. So once again, thanks everybody. Enjoy what's left of your Wednesday, and we will see you on a future session. Take care.
Thank you for your time. Bye-bye.
Thanks.